G'day, everyone. Welcome back to another episode of Spark Your Fire. I'm your host, David Shih, and as always, with me today is John Comino. John, how are you doing, mate?
David, I'm very well. I spent the last week getting over the lurgy that everyone's got, and but yeah, right as rain now, so all
Yeah,
good.
yeah. It's been cold in Sydney, don't you
Yes,
think?
that's right. That's right.
I don't know how our southern friends, down in Melbourne or Tassie is going to feel.
Yeah,
They must be in the icing degrees, but you know,
brutal.
oh, absolutely brutal. The
It's not
winter
winter
came
yet.
early. The winter came early this year, don't you
That's
think,
right.
John?
Yeah, it's definitely cold, definitely cold. So but yeah, and there's stuff going around, but all good now, all good. Good to be
That's
chatting to you.
true. And when I say the winter comes early as well, I think our governor Philip Lowe certainly delivered the early blow this month as well with another 0.25% rate high on a cash rate, which came pretty much unexpected for everyone. I think from memory,
Mm,
there was 0% of economists or the experts, so-called experts, to say there's going to be a hold in the May decision, and then come 2:30 around that time, bang, 0.25% increase,
yeah.
which everyone almost fell their chair. They go, what's going on? What do you think about that, John? Like, why would RBA pull another trigger when they did the pause last month? And look, I think from my understanding, if I'm understanding this correctly, the CPI data for Australia actually didn't look that bad. I mean, this certainly has peaked, right? Like we've gone past the peak; it's trending down now. But so it's kind of moving in the right direction, and unemployment still around the 3.5% mark, which is excellent.
Mm.
But why would RBA want to pull another trigger? Why do you think is that the
I,
case?
I think it was to, in a sense, wrong foot the market. I think it was a very symbolic increase. So the 0.25% is not a big amount. It's not going to shake the markets or anything like that. But
Mm,
it did signal to the market that there's still going to be hawks on inflation, and not to get too comfortable. I mean, they would see what we see, which is the property market's fairly hot, at least in the looking at month to month rather
yeah.
than year to year, and they'd be seeing that, and they I think that they wanted the economy. I think they wanted people to pull their horns in a little bit. Don't get ahead of yourself. We've still got this, and yeah, and also t- we still have negative real interest rates. So if we've got interest rates at 5% and inflation's 5 or 6%, or at least that's what it's been over on an annualized basis, we still have negative real interest rates. So they haven't really come out as Volcker type inflation hawks as much as we think they have.
Mm.
So maybe, yeah, I think it was a symbolic signal, which is probably the right thing to do, to say, hey guys, don't get ahead of yourselves. What do you think?
Yeah, look, I think when I read the minutes, sorry, the statement initially after, I think that the key message is, yeah, they want to be cautious. They want to make
Mm,
sure the inflation beast is under control, and they want to do it within the timely manner. That's the whole reason. It is coming down, but it's not coming down fast enough, and not quickly enough
mm,
in order to get to the 2 to 3% range that they've been aiming at between 2024, 2025, I think it was more likely towards the mid 2025 now, from
mm.
memory. So, and again, looking at the statement as well, they still putting in the comment around some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame. So
Yeah,
in a reasonable time frame is the key word here, but that will depend upon how the economy and inflation evolve. So again, it's a bit like, yes, we're never going to say this is going to be the last rate rise, right? Because that's going to give markets so much confidence that inflation is going to go on out of control again. So they always want to keep that tone to say, do you know what? We might be putting our finger on another potentially rise again, depending on what the data in the next couple of months is going to tell
yeah.
us.
Yeah. It's interesting though, because one of the things that you and I said on the day, just via SMS to each other, it's like, okay, if the 2 year yield is what's determining where they should be,
Mm.
the 2 year yield in Australia is 3.15%, and the rate that the RBA has set is, I think,
We're
3.85%.
currently on 3.85. That's correct.
3.85. That suggests that the if it should be at 3.15, if because that's conventional wisdom for for monetary policy. It should be the 2-year. It means that they've kind of over tightened now. So we're so suddenly we're looking a bit too tight at the moment. So should the rate be closer to 3.15? The market suggests that. So that's interesting. So this is almost a bit of a dangerous period of time now. If they leave the rates too tight, that's when potentially you could tip over into recession or something like that. But interesting that they did it even despite the 2-year being in the low 3%.
That's right, and they've always insisted that it's a narrow path that they're trading on at the moment to try to balance out the unemployment, balance out the CPI, the inflation beast, and at the same time not causing a recession to the economy, right? But having said that, I think this increase still had a lot of economists very concerned at the moment because it's like you said, they probably look at their data and then they think this is RBA being overly cautious and try to over tighten a little bit too much. The impact of that, I guess we will see. But look, in some further positive news, I mean, Fed and the US inflation data is looking to be a lot more under control. What was the inflation data last quarter or last month?
Two nights ago it came out at 4.9% annualized. I can't remember what it was for the month, but 4.9%. So that was below expectations. I think the market was expecting 5.1%.
Okay.
So it was a little bit lower. The market liked it. It's signaling the Fed's doesn't need to do a lot more. But I think while it's still near 5%, that there's still probably rate rises out there. But inflation's coming down very quickly.
Certainly in the US markets, and that would imply that there's more chances that Fed's not going to increase further on their rates at the moment, which would also have an impact on our ones because I think, ultimately, if Fed continues to increase rates, Australia's RBA will have to follow suit to a level degree as well. So hopefully, fingers crossed, this will be, or the 3.85 that we're currently sitting on, will be looking at more like the terminal rate that we are aiming, and there won't be any more triggers. But having said that, who knows in the next few months? I think it all comes down to the data set. Do you know when's the next key data set piece that's going to come out for inflation pieces? It's going to be another, because we just had the quarterly one last month, didn't we? So maybe another quarter, 3 months?
On the spot here, I'm not sure. I know that every Friday the employment numbers come out, so we'll get those tomorrow morning. But I'm not sure anything about anything specific. Yeah.
So look, assuming it's quarterly, and we got our quarterly data last month, then will be another quarter, which would lead us towards probably July-ish. So if worst case, maybe RBA potentially will. That'll be the key useful data for RBA to determine whether they may have to put another rate rise again. Or if the inflation data is looking a lot more positive now, and they can just put it on hold. But interestingly enough, I don't think anyone's been talking about reduction yet. And look, when I look at banks' fixed rates, which generally speaking, fixed rate is what they forecast in terms of what they think the interest rate's going to be. Let's say 2 to 3 years period, or even longer, right? They have been reducing a little bit of 3-year fixed rates, but we're still seeing things around the 5% to 6%. So that kind of suggests to me that we're not going to see a significant reduction in terms of the cash rate, at least not in the foreseeable future, in the next 2 to 3 years, at this point in time, that is. So,
well, the 10-year yield in the US is under 3.4%. The 10-year yields come down a lot. It's the wholesale shift downwards. So, I mean, 10 years is the never, but it's a very important benchmark. So they're saying that yields are going to have to come down again. So we'll have to watch that. But the interesting thing, as a lot of people who listen to us are property investors. One of the things that you need to understand is that the rental yield is going to try to match the lending yield. So if let's say where you can borrow at 6%, that's essentially what the borrowing rate is at the moment. The rental yield is going to need to go up to about 6% before the cycle is over. So at the moment, rental yields are still, on a median house, still be under 4%, probably closer to 3% for a house with a lot of land. Rents, I would say, have got a long way to go up. So we're talking about the rental crisis now, and again, you know, I hate the word crisis, but we've got a very tight rental market. That I can't see that. I see that the rents have to go up significantly higher from here to get to 6% yield, which is when it terminates. In a sense, it has to get to the lending rate. So that's one to watch as well. I don't think we're anywhere near the end of the rental cycle.
Yeah, certainly with the construction pipeline and all the construction company going bust, it's not helping in terms of building more at this point in time. And we got the migration tap turned on with more and more people just flowing through. So but yeah, no, definitely. But it's look, John, I think we also spoke about this. It's just I'm scratching my head because we are seeing this 3.85 cash rate. I think the last time we were at this level was probably back around 2011 or 2012. Okay, so it's been over 10 years before we kind of came back to this level. So you could say to a degree, yes, a lot of borrowers haven't seen this in the past. But at the same time, the property data suggests that it's also going up as well. So that's what's kind of contradicting for me. The mortgage rate has gone up, which means people's affordability has come down, which means they could not borrow as much as they can. Yet the property prices continues to do their own thing and continue to drive up. I mean, we're not talking about a V-shaped recovery, but it is certainly bouncing back. Looking at May's core logic data, I think Sydney was recording about 1.3% for April. So, and so this just doesn't make, I mean, I guess obviously I'm probably not, I haven't seen long enough to that level, but that's one of the questions that I've been wondering. Like, why is the mortgage rates going up at the same time when the price is also being shooting up? Do you have an explanation or do you have some sort of opinions on that?
The simplest explanation is that there's a shortage of supply. So we know that the number of listings is down about 20% off this time last year. And we know that the number of listings last year were down about 20% off the year before and so on and so on. So the answer is that there's a shortage. But I think more than that, I think that property has been a poor investment since about 2016, 17. So property market, I know that we feel it's sort of unaffordable, but property hasn't gone up that much in the last 5 years. So I also think that part of the issue is that real estate is relatively, it's going to sound strange, but it's relatively affordable now compared to historical periods of time. So if we're no more expensive than we were in, say, 2017, which was the top of a cycle back then, and I think our incomes have grown since then, and our rents have grown, so yields are more attractive. I think that real estate is relatively cheap, and if you layer in that the prices in the economy have all gone up except for real estate since 2017, real estate is looking relatively cheap. It sounds crazy, doesn't it? But real estate is looking relatively inexpensive during an everything bubble. I'm very critical of the economy. The economy's not doing the right thing. However, compared to what is what we need to ask ourselves? Compared to Dow Jones, compared to milk prices or bread prices or consumer prices, real estate's not that expensive anymore.
I think you touched on that a few episodes before as well. When you look at it from relative terms, it's basically the increase. Inflation has been going up too fast, and therefore, in the sense that the property prices have literally staggered around the same period and haven't gone up as much in comparison. So now it's looking a lot more affordable from a relative term, as you said. Perhaps when you compare that to gold or something, that's when these explanation would make a lot more sense. But I think at the same time, the other piece of puzzle could be because of the fact that most people have and believe that we are pretty much at the top of our current rate cycle as well. Yes. So that's giving people a lot more confidence to be able to go back in. We're potentially not going to see another 1% on top of what we are now. So therefore, when people do their budgeting, they go, okay, well, I can potentially now take out a mortgage and get into my first home. As a matter of fact, I think in February and March data have already shown from the mortgage lending perspective, they've been trending up, especially the first home buyers as well in terms of the first home buyer lending. So I think that's where it started to come back, and also in investor lending as well. So the loans committed is started to creep back. So that's new commitment. So we're no longer just, the brokers are no longer just playing in the refinance market, but they are actually new businesses, and people are buying in that sense. So
yeah. But only recently purchased properties are interest rate sensitive. So long duration held properties are interest rate insensitive. So if you bought a property in 2002, I'm just pulling that number out, but then you don't really care what interest rates have done. You probably paid off a chunk of principal, and you probably live in it now, and your circumstances are completely different. Now, if you bought a property into 2021, those couple of buyers, it's more than a couple, but those buyers, that's an interest rate sensitive asset. So the distress from higher interest rates doesn't cascade throughout the economy evenly. It's like a last in, first out sort of thing. But the majority of buyers are fine. If you anyone who bought prior to 2015 is probably completely unaffected by rate rises, I would think. And then how many properties do most people have? So even if you are in distress but you own one property, you could probably manage. It'd be those who got really into property and bought and levered right up. They would be in a different position to other people, but most people have got one house.
And I think it's also to do with those people who have overcommitted themselves during the extremely low interest rate periods, where the borrowing capacity is at the absolute maximum, right? And those are the people who are unfortunately starting to see a bit of struggle right now, especially when the fixed rates started to roll off. Your repayment could be thousands of dollars every month higher than during the fixed rates. So, but yeah, look, we'll see. I think the full impact hasn't really been felt yet by the property market, because there's still a big chunk of people who's still on fixed rate at the moment, which is due to expire this year. So I think the actual consequence of all the rate tightening done by RBA, plus the actual economy impact, we will probably see in the second half of this year. That's when everyone will really see what the impact of that is. I get very suspicious when people talk about cliffs. I mean, I remember there was the P&I cliff a couple of years ago. Interest-only cliff,
that's right, interest-only cliff. And now we've got the fixed rate. I mean, like, it's anecdotally, it's true that there are a chunk of interest rates coming off, but then circumstances change. Rates might go down. There might and cliffs also assume that these big events happened in a cluster, that there's enough people that it happens to them all at one. It happens to a bunch of people at the same time, whereas most people, circumstances are staggered in a different way, and so you do get slow moving car crashes rather than these big sort of front-on collisions.
There's still car crashes.
Yeah,
John.
That's why so the cliff is more like a hill that sort of meanders down rather than a drop off. But we'll see. Anecdotally, I get the argument about the cliff there. So
yeah, okay, all right. But yeah, look, as we mentioned, the property market is doing very, very well at the moment. Is there anything in particular that you want to touch on a core logic perspective that you thought is worth calling out, John, from the April data set?
Look, the only thing is really just to what we've already covered, which is it is quite staggering how robust the market is. I mean, the Sydney market went up by 1.5% in a month. And if I look at the CoreLogic data in May, which is as yet unpublished, but it comes out through a daily index, May is going to be stronger than April. So we're now sort of in a 1.5% per month cycle, which is 10% a year. I mean, it's okay if that happens this year because we came off 14% last year, but it's not. This is a fairly rapid tick of growth, surprising a lot of people.
Yeah.
The only thing I'd say is it's kind of evidence that no one should be spending too much time trying to forecast the future. The big crash in 2022 was quite surprising. The big recovery in 2023 is quite surprising. So what you do, you just need to acquire good assets. You need to not worry about the timing because you're always going to be wrong. And I can speak from first-hand experience there. But apart from that, what was your takeaway from the data, if anything?
Look, I think if we marry that up in terms of our actual on-the-ground experience, that would probably make a lot more sense for our listeners. I've obviously been hitting up the pavements and seeing inspections for the last couple of weeks on Saturdays. And I guess the summary that I'm seeing right now is there's literally just no stock. There's nothing to buy, like as you said, and that backed up with the data that we just spoke about earlier as well. Literally 1 in 4 houses. That's a lot less in comparison to 12 months ago. No stock, and on top of that, no quality stock. It's all pretty much B grade or even worse at the moment. We're not looking at A grades or anything that's slightly better than B grade. It comes up and it gets snatched up straight away. Like it's not going to last long, where you see a whole heap of B grades and C grade that's kind of sitting in the market. The vendor's not in a rush to sell. Most what I find is the vendors already don't have a mortgage or anything like that. They just want to basically get a good price. So they're not in a desperate position to sell. But yeah, not a lot of mortgagees, not a lot of desperate sales kind of situation. Everyone just kind of hums along, and yeah. So I think and what I deduct from that is certainly most people are still able to hold on to the properties. Now, some investors might started to sell the B grade properties in order to alleviate, like that's what I'm hearing, when asking the sales agent, why is the owner selling? They're saying, oh, well, either the vendors are starting to upgrade, like they want to upgrade their house and pay off a bit of a debt, or they are looking to get rid of 1 or 2 investment properties to try to help with a better cash flow. So logically thinking, they want to keep the quality properties, and they're getting rid of the dud ones or the duddier ones in their I don't even know whether that was a word or the crappier ones, the non-performance in their portfolio to a degree, and to help maximize cash flow because of the rate rises to hedge against that. So but yeah, there's just no stock. There's nothing to buy. And what about you, John? What are you seeing at the moment?
Yeah, similar. I bought a property for a client last week. I knew this property was 7 Hills, and the brief was essentially buy something within 1 kilometre of the station. I mean, I'm simplifying, but that was the brief. And there are no properties within 1 kilometre property of the station, unless you want something that's like R4 land that's going to be developed by a developer. So there's this one property that I knew that was coming up. And I knew about it for 4 weeks before it hit the market. They wouldn't sell it to me before because there is no stock. So they needed, for their own branding, it to go to market. Goes to market. We saw it before it came onto the market, and we were able to purchase it within hours of it going onto the market. But it needed to go onto the market for branding and all that sort of stuff. So we were waiting around for this property for 4 weeks, essentially knowing that we were going to buy it. And so very interesting.
Interesting one.
But yes, the challenge there is it's a challenge for the buyers, it's a challenge for the sellers. There's nothing out there. There's nothing to buy. And those good properties, things in good locations or things that are well made, things like attractive looking houses in good positions, they do sell pretty quickly.
I do notice though, John, I don't know whether you're seeing this. There's quite a few off-market opportunities, or a lot of sales agents try to kind of present it that way. Now, I don't know whether that was because the seller is trying to see whether they can cut a deal underneath the table, or they could probably easily withdraw if there's no interest that's up to their expectation or price expectation. So it's kind of like a soft launch, if you know what I mean. They don't want to put it on the market, but yet they kind of want to test the market a little bit to see what happens if I put this property out on the market. What could I potentially get, and what sort of interest would I be getting? And if that doesn't go against what I want, then I'll take it back. So I keep it as an off market to a level. Are you seeing some of those in?
So I buy a lot of off market just because I'm trying to give my clients an advantage. I'm finding that recently it's a little bit more challenging to get vendors to agree to like an off-market private treaty sale. And that's because they don't have anything that's going to get them in the real estate pages. And if they sell everything off market, they've got nothing to market. So I'm seeing that, but I wasn't seeing that, say, 6 months ago. So 6 months ago, it wasn't quite so dire. So the stock levels are even tighter than they have been for quite a while. So I'm seeing a little bit less off market at the moment.
Yeah,
I mean, like there's they won't they want to put the ad up, they want to put the sign out the front, and then they're happy to sell it as soon as that happens.
Yeah. Okay. And I think part of that is probably due to the fact that there's optimism in the market at the moment. We're seeing clearance rate 77% last weekend in Sydney.
Yeah.
Is that right? Yeah. So that's close edging up to 80%, which is actually now starting to move more into a seller's market, right? Anything over 80%, I think,
exactly.
Is
that's right.
Market. So, a lot of sellers will be wanting to actually get it fully advertised, go through the campaign of 2 to 3 weeks, and then get the auction to try to get the best potential sell price that they can. Which would probably, that's what I think. But having said that, I think, because I'm monitoring more of the units market, whereas I think you're on the house market. So units markets are running at a different pace as such. So the units market, I think a lot more people were happier to try to test the soft launch instead of going down the full-blown advertising, marketing, and auction route. I think it's a very interesting times at the moment. Changing gears, John, a little bit. So there's actually a few finance pieces which I just thought I'll touch on as well to keep our listeners up to date. One of them is an interesting article that I saw on Switzer Daily this morning in regards to talking about some of the people have started to look at withdrawing super to help them with potential mortgage repayments coming up. So that was an interesting piece, and I just thought I want to share that because of the fact that we are seeing, and for some of the people who are concerned, in 2021 and 2022, there were about 56,000 applications made to withdraw super. Wow. 34,000 were approved. Okay, so that's totaling about 573 million. However, not all that funds going into helping with mortgages. Out of that, only about 9 mil, so $8.9 million was for mortgages. Okay, now this is before the Reserve Bank interest rate rises. Okay, 2021, 2022, right? Okay. We have not yet gone through 11 rate cycles. Okay, now moving on to today, or more closely now, modern days, the Australian Retirement Trust, which had about 240 billion worth of super fund members, okay, has received about 600 withdrawal requests in March alone. 600 withdrawal requests in March, okay? And that's because when people can discover that they can use the super to avoid losing their home, the requests for super help are bound to surge. So, I think this is actually going to be an interesting one to watch as well. You did a quick Google around the average super that Australians have. What was the actual figure?
Oh, look, I got it per age, and so it doesn't have the average super. But let's say the average 40-year-old has $90,000 worth of super.
Okay. 40.
Yeah.
Okay. How much can they take out in that case, right?
Well, that's exactly right.
So, yeah, and the age group that will be making these type of requests, not surprisingly, is between the 30 to 50-year-olds. In other words, the one that's heavily mortgaged in that sense, right? So while it can help, but it's not really going to fix the problem fundamentally. But just need to be mindful, like when people are in dire straits situations like this, to actually take the super out, it's not looking great. And I can't help but think of when the governor talks about how much money people have in the offset account to be able to weather the storm. And they were roughly about 24 months ahead on their mortgage repayments previously. But, I actually suspect that the money in those offset account or withdrawal accounts have gone down a lot quicker than what people have anticipated because of the fact that people spend it on holidays. There's a lot of travel, et cetera. So watch this space, because if more and more people started to creep up and try to apply to get super to help them with mortgage repayments, it's probably an early indication in terms of what could be coming for property market, because it's not going to be it's not a solution. It's basically also, it's a band-aid, right? Like you said, 100%. If they take 30K out, how many months can they cover? They basically try to be able to survive at the moment. Now, whether we will see another mortgage holiday like what we're seeing during COVID period is another story. At this point in time, I don't think so, but we'll see. Okay, so
it's very, very interesting, and I mean, people say, you know, my retirement is my house, and I'm sympathetic to that view. However, you can't eat your house, and I just think it's very short term thinking. But I'm very sympathetic to the view if you don't own a house and you've got $100,000 in your super, it's like, oh gee, what would you rather do? Well, you'd rather buy the house. Anyway.
So I think it's not really a long-term solution at all for those people who is withdrawing super at the moment. And while we're talking about it as well, you know, if you are experiencing financial hardship, you should always contact your bank first thing. Let them know. They will be able to discuss and let you know if there's anything that they can do to help. You know, they might be able to pause a few months or look at changing your repayments from P&I to interest only for a few months. A bit of special exceptions, but never leave it till last minute, and never try to go to the dire straight and tap into your super before running past potentially your lender. See what I can do. Okay. Okay, so I've got a couple more points here. One more is related to the assessment rate change. Okay, so this is interesting for those people who have not have any idea. Right now, for loans, if you're looking at refinancing or purchasing, what banks do is they actually assess at 3% on top of the actual interest rate that you're going to be getting. So let's say, for example, John's looking to buy a home. He's upgrading for a home, I should say. He's already got one. So John's looking to upgrade, and his bank's offering him 5.5% on his own occupier mortgage. Now, when the bank assess that, they're going to assess it at 8.5%, so 3% on top of what he's actually going to get today. Okay. Now, a lot of people were not able to refinance because of that 3% buffer that's in place. You know, a lot of people that's on a higher mortgage, maybe a 6% or 7%, you know, they are stuck at the moment. But some good news for those people, because I believe banks are starting to loosen that assessment rate. So earlier this week, I think we're already seeing Resimac, which is a non-bank lender. They have loosened the 3% buffer to 2%. And not officially or unofficially, word on the street is the Westpac group will actually be reducing the assessment rate down to 1%, potentially for refinancers only. Okay, so if you're looking at dollar-to-dollar refinance, they will be able to just assess you on, using John's example, 6.5% instead of 8.5%. Okay, so that could help some mortgage prisoners who's currently on a very high mortgage, unable to refinance to reduce their repayment whatsoever. That could actually help them in that instance. Okay, so John, what are your thoughts on this?
It's a very practical response to the bank never really wanting to repossess your home. That's the banks don't want that. The banks would much rather an environment where property prices are going up and you can service, and that they don't have to take control. So that makes sense to me. You know, when I hear about those sorts of things, I always think that being on principal and interest solves a lot of problems in the long term. Like if you can chip away at the debt, and then you go back to your bank, say 3 to 5 years later, but you've got less debt, it's just a different conversation you have with the bank. So I'd say that even though I recognize that when you're buying investment properties, you know, cash flow is the main game in town, and interest only is common. I still think there's a very strong case to, particularly at the early stages of owning a property, to do principal and interest, because it will get you out of hairy situations later on, including refinance.
That's certainly something to consider, and I guess, you know, that's personal. It depends on the personal circumstances and situations. Just imagine if everyone's putting their P&I repayment on the 6% investment mortgage at the moment, it's going to be pretty negative at the moment. So anyway, you know, that's just general advice, and obviously, you know, from John's experience, let's put it that way, being a property investor in this game for a long time. So
that's true. Yes. But look, it's very, very practical of the banks, and it's good. It also suggests that they think that we're at the end of the rate increase cycle. So one of the reasons why they might consider 1 or 2% buffer is because they don't think it's going to get there. So it's probably a signal that they're internal modelling is suggesting we're near the terminus rate.
The 3% buffer does make sense previously when we are at 2%, 3%, right? That kind of actual interest rate. But now we've gone past that. And, we were chatting about this before we come on air before as well. A lot of people, when they lock in the fixed rate at, say, 2%, they were being assessed at 5% repayment and they were getting a pass. Now the mortgage rate's at 5.5 to 6% or even higher. That's already gone past in terms of the affordability test that we were doing literally 12 to 18 months ago. So just imagine how quickly that things have changed now, So that's why I think, it has been the industry has been advocating to say this assessment buffer has to change because it's no longer fit for purpose. And I'm glad to see that we have got some wins here, hopefully for some borrowers who were stuck previously.
Yeah, there's a great quote from Tom Panos, and I think he stole it from someone else, but I'm going to give it. We'll attribute it to Tom Panos, and he said, and he was encouraging, I think, someone to buy at an auction, so maybe that's the context. But he said this great line, which is that when you buy a property, you get married to the property, but you only date the interest rate. So interest rates go up and down, but you're stuck with the property. It's a good way to think about it too.
It is. It is. That's a great analogy, actually. Yeah. I wonder who Tom stole it from. Anyway, it could have come from Tom as well. He's a pretty wise man too.
Yeah, he's a clever guy.
Yeah, he's a clever guy. So, all right. So that's the latest, and also also a quick update on refinance cashbacks, which I know is being one of the hottest topics between refinancers for the last 12, 24, however long, right? CBA and Bankwest have announced that they are stopping their refinance cashback. So they're no longer providing the $2,000 refinance cashback, I think, by the end of this month for those people who are refinancing. So this used to be something that the banks was providing to attract new customers. And there has been a fierce refinance war that's going on. So this kind of is the fuel, that's what's fueled all the refinance. And that actually incentivizes a lot of churning. To a degree. So just imagine, I know I spoke to a couple of people, basically you could jump from lender A to lender B to lender C to lender D, and you could probably make a $10,000 or, a bit of bonus just by jumping around to different banks. But first of all, that's not good for your credit. So please don't do that. You'll be ruining your credit for the future when you need that credit. Number two, banks probably start to recognize that if the borrowers keeps on doing this, then they're actually losing money because they're just basically throwing money away. And as we all know, the cost of funding just keeps on going up at the moment. So I reckon CBA, being the first one that made this change, could have recognized that. I mean, they put it out very bluntly to say, look, we're not going to participate in that refinance war anymore. We're going to stop it, but we're still going to provide competitive market rates, et cetera, et cetera. But I reckon, at the back end, it might be a cost of funding issue. They're starting to feel the squeeze. It's not worth to try to get as much, try to give that out. And they want to attract quality customers at the end of the day. So that could be part of it. And also, there's been pressures from the mortgage finance associations to basically terminate this because, like I said, it's incentivizing refinancers to churn so often that it's not in their best interest, and it's not in anyone's best interest, to be honest. So that's CBA and Bankwest, and also I think NAB has just announced that they will be scrapping it as well. So I do expect that there will be more lenders that will be joining it. Having said that, I reckon there will always be lenders that will just continue to play around this field. I mean, you can't control how banks will run and how people will do things. So
yeah, right. Interesting. Yeah. I mean, it'd be. I hope no one was refinancing to get the bonus, but stranger things.
Trust me, there's a lot. There's a lot, John. You might be surprised, but anyway. That's good. So, look, I think that's pretty much all we want to cover this week. John, have you got anything else you want to chip in?
Nothing else. Times are good.
Great chat as always, John. Thank you for joining us, and thank you, listeners, for joining us as always. We hope you like this podcast. If there's any feedback, anything you'd like to see more, just put a comment down below or email us at sparkyourfirepodcast@gmail.com. Again, none of this is financial advice. If you are wanting to take away, please go and see your specific advisors, accountants, brokers, buyers agents, whoever that's really in your team. But until next time, we will see you again in that episode of Spark Your Fire. John and David, bye.